So if we look right here, this is the Dow in December 21st, 2018. Now you can see in November 2018, the Dow was around 26, 25,000 point and give or take some. And now since then, it dropped 16, 16.8, let's call it 15%. And this is the reason why new investors lose money. So now, of course, this year's markets have been so volatile due to the China trade war and which now has caused some economic uncertainties, whether we're going to a 2020 recession or not. My opinion is that we're not going into any recession, but if the trade war keeps what it's doing up and there's not a trade deal resolved, then we're most likely going to go into a recession. That is my opinion. I mean, again, don't quote me on this. I'm not a financial advisor or anything, but that is just my opinion as an investor. Now here's where new investors lose money. So the new investor will come in and any day, any type of day, and will buy around November 7th, 2018. Next day, November 8th, Dow drops 300 points or so. Now, at that moment, if you are invested, or if you're invested into a dividend track fund, now you just dropped about 0.3%. So, I mean, you lost money. So you're not feeling well. Yeah, emotion starts kicking in, and that is your worst enemy right there. You see that you lost a 0.3% of your money, or 3% if you kept holding, and you begin to feel overwhelmed. That's money that you worked for, so you just lost it. But here's where that's a mistake right there. Although the Dow dropped about 300 points here to 25,000, if you kept holding, and let's say you would have bought more stocks of whatever certain stocks, or maybe a ETF or a dividend tracked fund down here, when the market comes back, when the market comes back about a few months later from that drop due to the Fed. I think that's when the Fed rose interest rates. Again, don't quote me on this, but I feel like that was the time they rose interest rates very high, just like Donald Trump said it, too quick, too fast, too furious. And then a couple months later in April, it's at 26,000 points again. So if you would have bought here, I mean, from there you would have been up already 20% year to date. But the new investors didn't do that. They saw here, they came in at 2600. They did about 3 or 5% drop, and they sold here. Now they lost money. So now when it came back up, they decided to come in again and saw, oh, okay, maybe I can try this again. And some in particular still ended losing money, because at the end, then a few days later or a few weeks later, the Dow went down. The Fed rose interest rates, and the Dow went down to 21,000 points in 2018. But let's look at the 5-year chart. In 2016, the Dow was 17,265 points. If you would have bought here, which is right here, and held for I think it looks like 2 years, you would have been up 51%. Again, this is if you're holding a, a Dow Jones Industrial Average tracking fund, ETF, or anything like that. So I mean, although the market looks a little bit rocky over here, because I mean this is where the China trade on uncertainty started. In the end, it'll always end up coming. And I mean, if investing for the long term, you will always do well. I see. You can tell since 1974, the Dow's up 3,208%. That is your money. That is like investing 10K in a dividend tracking fund. I think you would have been up about hmm three 3 million, maybe more. Again, don't quote me on that. So let's go back to let's go back to the dot-com crash, because this crash was really interesting to me. So let's go back to 1999. The Dow was 11 around 10,000 points, and then it took a sharp drop to 23 and dropped 23% to 8,000 points. Now, of course, right here in 2000, I think in 2003, the market also dropped 10% due to the Iraq, Iraq, U.S. and Iraq war, and I think it lasted in 2003. And then here in Business Insider, the market, according to them, the market dropped 10%. Usually, because a war is not really that that good for the economy. So I mean, that was an expected drop. I mean, what what else? What else could you have? Well, I mean, what the outcomes of war? I mean, you're either the winner or you're the loser. I mean, of course, the U.S. was a superpower back then, but still not that well for the economy. So, I mean, you would have even if you would have bought here, and then you would have hold to 2007, 2000. I mean, 2007, you would have been up 84%. And then the 2008 recession or 2009, either one, where people couldn't pay their mortgages, and a lot of people made a lot of money by shorting them. There was a movie about that, The Big Short. I'm sure you guys seen it. Now, I'm not sure if you haven't. And then even if you hold it here, I mean, you would have taken from your early gains, you still would have been up 20% or so, and you could have bought here again. But this is over almost 20 years. I mean, we're in 2019, about a few months away. I mean, 1 month away from 2020, and the dot-com crash was in the 2000, 2001, or the 2000. So I mean, from there you would have been up 180%. But that's not what new investors focus on. They come in, they don't know much about stocks, about the dividend yield, about growth, earnings growth, EPS, all that, and then they just buy here. They buy at a point, and then when they see they're down, they sell, and then when they see they're up, they're like, "Wow, I missed out on these gains," and then they try again without any knowledge, any lesson that they learn, and then when they tell people about the stock market, they say, "Oh no, the stock market took my money. Oh no, I can't do that. That's just for managers. I tried, I couldn't do it." But really, you just didn't apply yourself. Because here's my M1 Finance Alex Pass. I mean, my name is Alex. Alex Passive Income Portfolio. Now this is worth 4,789 and 42 cents. Now this is actually my first time being with M1 Finance, but this is my dividend income portfolio. Now this I just started it. I think it was today. Oh, no, not today. Maybe 2 days ago I started a fund, and since I feel like right now there's a lot of uncertainty, but I'm also in here for the dividends. Now I think this portfolio provides me a yield of I think 3.7%, and here you can go to each one of my slices. So the M1 Finance is a brokerage that allows you to buy partial shares of a company. So here I have about 55 holdings, and you can go to let me see if I can go back right here. Oh, safe. Oh, no idea what's going on. And then here we can go to healthcare right here. I'm actually healthcare is my largest. Well, I'm overweight. You can say I'm overweight on it. So 16% of that 4,784 went to healthcare. 13.9% went to bonds. 13% went to real estate. Another 13% to finance. 9% to consumer. 8% to utilities. 7% to telecom. 7% to tech. 6% industrial. 4% energy. Just in case. Just just like that. I mean, M1 Finance allows you to go to a pie, and you can find your type of pie. Maybe you feel like you prefer more high growth stocks and you want to go into an aggressive portfolio. I don't. I feel I chose passive income because that's what I want. I want my money to work hard for me. And the thing with high growth stocks is that although you get a big opportunity, you can rise they're growth stocks, so you can make a lot of money, but at the same time you're also risking it, and you could lose a lot of money. So this is my healthcare one. Here you can see the slices. We got Johnson and Johnson. I know there's a lot of controversy around them lately, but I mean, when has there never been any like controversy around them making baby powders that they'll kill you or something strange like that? I'm not sure what the article is, but it's always the same thing with Johnson and Johnson. I mean, they've been around for a long time. I don't really think that any of this short-term troubles is going to be any issue in the long term. But I mean, of course, as an investor, I'm worried, and I'm still going to keep checking. But over the long term, I don't really think that is going to affect them in any way. They're just going to keep on, of course, paying their dues to those people that, okay, if they did, they hurt. And if you are one of those people that are watching, my condolences. But yeah, the so we got J&J, Pfizer, Amgen, Abby. Now Abby's a little kind of a growth stock for me because they took a recent down since they did an acquisition of another giant pharmaceutical company. I can't think of the name right now, but they're kind of a growth stock to me right now, and a dividend stock because they paid out 5%. You go to, all right, let me press Abby right here. Abby pays like a 5% dividend yield. Let me get, if you go to details, look at that P ratio 25, which seems a little high. I guess not. And a dividend yield of 5.6%. So I mean, it's a crazy yield, and I mean, with the acquisition, they were just trying to lower their reliance on a drug called Humira. I'm sure a lot of people have used it as a very nice product. I mean, they lost a lot. They lost a lot of patenting for it in the U.S. I think though I know I think they'll lose it in 2022. Again, don't quote me on that. I'm not sure. And I think some in Europe, but yeah. So they made a giant acquisition to lower their reliance on that product. So that was a pretty smart move. American company we got here, Medtronic and United Health Group. So here each one of these buys holds 19%, then 18%, Amgen holds 16%, Abbey 15%. And I mean it's the same thing with the other ones. We go to the bonds, and I think each one of these bonds pays a monthly interest, or some of them may pay two times a year. But I also added here AG&C Investments as a REIT, real estate investment trust, I believe, and this is just an ETF that pays monthly dividends. This Invesco S&P 500 high dividend low volatility ETF. Now with this portfolio, the goal is to create more passive income and grow it until 10 years from now, where the portfolio will grow to at least $500,000 would be a goal, and that way act with a 4% dividend yield, and you could live off that. Because the thing is, you can't just go into a portfolio and start chasing yield. Yield is not the thing that's going to get you there. You need to be safe about this. Now the key takeaways for the emotional investor is sometimes investors can get greedy or have too much fear. I mean this is the reason why many people buy at market tops and then sell on market bottoms. Then they underestimate the risk. So again, investors search for a yield that's 12%. Before you know it, next month or next 4 months is not sustainable. And I mean that's a great thing that even if the economy crashes with this portfolio, I mean the income is gonna go up. I mean the value is gonna go down. So maybe if it crashes, let's say tomorrow, maybe in a few months, this 4,700 is gonna drop to about 2,500. And then the yield, instead of being 3.7%, which it is now, is gonna probably increase maybe at 2%. And I mean, all these companies have done, I think I've checked into one of them, have done historically well in the past, and they should continue to do so in the future. So that is one of the reasons why I picked this portfolio. And now this is my Robinhood portfolio. I mean, it's I like, and I think it follows the same metrics. And I mean, if we look into this.